Okay, so 2 weeks ago, I think, we have published a research paper. The point was to explain how does our protocol, Synthereum, is working. Also, what are the use cases, the roadmaps, and so on. The thing is that it's a 40 pages research paper. So the point of tonight, it's first to explain, maybe in a more friendly way, what you can read in this research paper. And also, since now we are live and on the minute, I wanted to take the opportunity to introduce a new series of video in our YouTube channel. The idea is that every month I will take the micro and to explain you what we have done in the past months, or what is being done at the moment. And like that, you will be able to follow again in a more friendly way. So let's start. I will share. I don't think I need to share. Actually, it's already being shared. So let me click. Okay, I just want to see if you see the image. Yeah, for basic question, you can ask them here. And I will do a small presentation, and after you can ask any kind of question. I just want to be sure that the PowerPoint started, but it looks like that it's blocked. So I will just stop sharing my screen and reshare it again. Okay. Okay, do you see the second slide? Just to be sure that it works correctly. Yeah, we do. Okay, super. So my name is Pascal Talarida. I'm French. I think you have get it with my incredible accent. I'm bankless and farmer. Bankless because 2 years ago, I decided to do a small experience. I wanted just to try to see if we could live only with DeFi. So back then there was nothing. I mean, there is not a lot of opportunities. There was only Compound. Aave was still not existing. And the idea was, okay, can I put my asset in Compound, for example, try to make a living with the interests? And this small experience became actually incredibly lucrative and incredibly exciting. And I pursued this experience, and I'm still bankless. And right now, I like to say that I am a bankless farmer because, yeah, I think my main resources now are from the farming. So what is Synthereum? So Synthereum, first, we have a mission, and our goal is to bring as many people as possible in DeFi. The problem is, for now, DeFi is not scalable, but Ethereum 2.0 and all the scaling layer will address this issue. So it doesn't belong to us, the responsibility to scale the network. Then you have, of course, complex user experience. I mean, even though for you and me who have some habits with MetaMask and so on, we may find it quite easy, but no. So this is why we need the folks like Argent, the wallet from the Belgian guy who tries to abstract all the complexity. But also one of the main issues, which for me blocks DeFi, is that right now we are only focused on with the dollar. I mean, dollar is everywhere, and somehow there is this kind of supremacy about the US dollar. And for me, according to me, if we had forex in DeFi, if we had more stable coins, for example, if we had euro stable coins, if we had Canadian dollar, pound, and so on, then maybe we could leverage from this forex infrastructure to onboard more users, but also to allow people from different countries to leverage from what we can do in DeFi without having the obligation to be exposed to the price of the dollar. So basically, this is what we do. We want to create a robust, liquid, and very composable infrastructure on Ethereum and on various EVM-compatible chain in order to bring forex, but also other markets, stocks, indexes, and commodities. But as of today, we want to mainly focus on forex. So I will explain you first how does the protocol work, and after we're gonna go with some use cases. So first, it's to mint synthetic assets. So we are in the business of synthetic assets. But the cool thing with our protocol is that you could mint synthetic assets through various methods. So the one that is live right now on the mainnet, it's called liquidity pools. And I'm going to explain you how does it work. The second one that we will start working on it next week, it's called the borrowing pools. And the last one that maybe we will work on it this year is called the derivatives pool. So the cool thing is that it always works the same way. You have a trader who deposits a collateral in a pool. So either a liquidity pool, a borrowing pool, or a derivative pool. Then this deposit and this collateral is used to over-collateralize a synthetic asset. The synthetic asset is issued on the UMA platform, and then it goes back to the user wallet. So you have this small drawing on the side which explains the schema. So the main features of the protocol are that we can enable a very strong peg. As you may know, one of the issues with synthetic assets is that you always need to find a way for them to maintain their peg. So it was quite hard for DAI to maintain a peg with the dollar. It's quite hard for synthetic stocks issued, for example, on the Mirror protocol to keep a very strong peg. So one of our features allow basically to enable a strong peg. Then you can trade USDC against our synthetic assets, but also you can exchange synthetic asset for another synthetic asset without slippage. So we basically have somehow the same value proposition here as synthetics. Atomic swap as well. This is one of my favorite one, and I will explain you why it is an atomic swap. So atomic swap between any ERC20 token and one of our synthetic assets with a deep liquidity. We also are able to bridge fiat with synthetic asset. We can borrow synthetic asset against a collateral. And of course, we can go long and short. For example, here I'm going to discuss about the forex. So we can go long and short on the forex with a very reduced risk. So first, how does a liquidity pools work? So it's quite easy if you know how a broker is working, then you will understand it pretty clearly. So first you have the trader who wants to buy J-Euro, for example. J-Euro is our synthetic asset tracking the price of euro against the dollar. So they have to deposit 100 USDC, for example, in the liquidity pool. As soon as those 100 USDC are deposited, what is happening is that the liquidity pool will deposit 200 USDC in a UMA contract. The thing is that the user, so the trader, they have deposited 100 USDC, and the other 100 USDC are coming directly from a liquidity provider. So basically, you have a trader and a liquidity provider who are entering into an agreement with a smart contract. They both deposit USDC, and then the USDC of both the trader and the liquidity provider goes together on one UMA contract. And then the UMA contract issue J-Euro. And for example, if the user have deposited 100 USDC and the liquidity provider have deposited as well 100 USDC, so those 200 USDC will over-collateralize $100 worth of J-Euro. So doing that, you have an over-collateralized synthetic asset 200% basically, because you have $200 collateralizing $100 of J-Euro. But from the user perspective, there is no over collateralization. You just send USDC to the contract. The prices at which those trades are happening, it's basically coming from Chainlink. So we take an on-chain price feed, which is trustless and decentralized. And every time the trader wants to buy or wants to sell, we use the Chainlink price feed. Like that, since it's trustless price feed, we can ensure to the trader, but also to the liquidity provider, that there is no conflict of interest. No one can manipulate the price feed. And like that, everybody can trade in a trustless way. What is important to understand here is that you have a counterparty. When you do trade using a liquidity pool, your counterparty is a liquidity provider. What does it mean? If the price of euro against dollar is going up because you have bought, you are making profit. From where are those profits coming? They come directly from the deposits of the liquidity provider, which means that every time you win money, the liquidity provider loses money, and vice versa. In synthetics, for the one who knows how does it work, it's almost similar, but the difference is that the profits are paid by issuing a debt. So there is not really liquidity provider in synthetics. You trade against minter who are issuing a debt. And then if a trader is winning, there is more debt which is issued. If a trader is losing, there is a debt which is cancelled. So here, if you understand synthetics, it works the same way, but without the debt system. So that's pretty much it for the way a liquidity pool is working. Then the question is, what happens if the price of euro-dollar goes up at the point where there is not enough money in the contract to pay the profit of the user? At the end of the day, if euro-dollar goes up by 200%, the trader will win 200 USD. See? So there is enough money in the derivative contract to pay the trader because he has won 200 USDC and the contract holds 200 USDC. But if the euro-dollar goes up a bit more, there is not enough money, which means that the contract will be under collateralized. So like any synthetic asset protocol using a collateral, at some point, a liquidation will happen. So basically, when the price of euro-dollar goes up and the collateral ratio falls below 120%, the position could be liquidated. In that scenario, the only one who is losing funds here is the liquidity provider. So basically, only the liquidity provider can be liquidated. The user cannot be liquidated. They will still have their J-Euro, and they can still exchange them at the Oracle price. So they won't have a loss, while the liquidity provider will be liquidated. So the fact that we are using a liquidity pool, it allows, as I say, cool features, one of them being a strong peg. So try to imagine if on SushiSwap, for example, where we have listed the J-Euro, the price of J-Euro against USDC is quite different from the price that you have on the Chainlink with the Chainlink price feed. So if there is a difference, it means that there is an arbitrage opportunity. So basically what will happen is that if the price on Uniswap or SushiSwap or any AMM is lower than the price given by Chainlink, there is an opportunity for you to basically go on Uniswap with USDC, buy from Uniswap or SushiSwap or Balancer the J-Euro with your USDC, and then sell them on Synthereum at a higher price. You can, of course, do the opposite. If the price on SushiSwap, Balancer, or Uniswap is above the price of Chainlink, then you will use USDC to mint J-Euro in Synthereum and sell them at a higher price on the AMM. Doing so, what you're going to do is that you will help the price to be more stable. Because as you may know, when you sell on an AMM, you will make the price going a bit lower. And vice versa, if you buy on an AMM, you will make the price going a bit higher. And the fact that we have liquidity pools, it means that anyone can do this arbitrage. So of course, I don't expect you to do some arbitrage. It will be bots who will be run by other people who will perform those arbitrage, but literally anyone could do it. So this is pretty cool because first, it can create a lot of fees for many parties involved. Every time there is a trade using Synthereum, there is a trading fees which is paid by the user to the protocol, but also to the liquidity provider behind Synthereum. And every time, of course, there is a trade happening on the AMM, there is also a fees paid to the AMM. So what is very cool with this system of liquidity pool is that when someone trades our synthetic assets using an AMM, we can still capture some trading fees. If you take the example of Mirror protocol, for example, if you issue a stock, a synthetic stock, and then you put them on an AMM, all the trading is happening on the AMM. So Mirror do not capture the trading fees that are happening there. Of course, there are some arbitrage, but no fees are captured apart if you close your CDP for the one who knows about Mirror. Here in Synthereum, it's quite different. Every time someone will buy or will sell on an AMM, it will make the price on the AMM to move, which means that it can create an opportunity to do an arbitrage. And an arbitrage will, of course, involve a trade on Synthereum. So doing that, anything that is happening on an AMM may produce a trade on Synthereum, and this will basically create a fee. This is why I'm saying that the cool thing with this design is that even when someone is trading on an AMM and pay trading fees to the AMM liquidity provider and protocol, there will be an arbitrager who will come and make an arbitrage if it's possible and pay fees to the Synthereum protocol as well as the Synthereum liquidity provider. So I hope that you have understood first this part. If you have any question about the way a liquidity pool is working, feel free to ask them in the chat right now. And at the same time, I'm trying to see some of the questions, if there are any. Yes, so the PEG, someone explained you what it is. Okay, so let's assume that there is no question. So this was the way a liquidity pool is working. And as I said, we are live already on Ethereum layer 1, unfortunately, with this design using USDC, which means that if today you go to app.jarvis.exchange, you will be able, with USDC, to interact with the Euro, GBP, or Swiss franc liquidity pools in order to buy basically the synthetic assets. So the fees are 0.2%, 0.1% goes to the DAO, and 0.1% goes to the liquidity provider. But unfortunately, you also have the network fees, the gas on Ethereum. And right now, I didn't check actually in the last minutes, but last time I checked today, it costs between $80 or $90 to mint a synthetic asset, so to trade against the liquidity pool. So this is why in the other part of this live, I will discuss, of course, about scaling solution and where we will go. Okay, so now I will explain you something which is very cool. We called them the borrowing pools, and I see that I forgot one R in the word borrowing. So the cool thing about borrowing pools is that you could basically borrow from the protocol. So the protocol can become something like a bank. So the idea is very easy, and it's the way most of the synthetic asset protocol are working. Mirror is working this way, MakerDAO is working this way, and UMA, on the top of which we are built, is also built this way. So the idea is simple. You have a collateral, but this time, instead of doing an agreement with a liquidity provider, you deposit this collateral in a borrowing pool, not a liquidity pool, and then you can self-issue a synthetic asset. So for example, you could deposit 100 USDC, and you could borrow from the protocol up to, for USDC, it could be, for example, 70% of the value of the USDC. So you could borrow up to $70 of JEuro. So the two models, one with a liquidity pool and one with a borrowing pool, they are serving different purposes. Here, there is no trade. You do not have a counterparty, so there is no counterparty risk. But also, the cool thing is that you could borrow from your portfolio. So at the beginning, we will add three collateral. So the first one will be for sure UMA, so UMA token. Then most probably we're gonna hold the vote, but I'm pretty sure that link token will make a lot of sense. Why? Because we use Chainlink, we use UMA. So the idea was to first start with tokens of the project on the top of which we are built. And we are, of course, seriously thinking about using GRT in order to use our token as collateral. So the idea is that, as I said, you borrow money from the protocol. This will allow the protocol to scale a bit more, to increase the TVL, and also to be able to basically spread our synthetic assets in the entire DeFi. So why we have done that? The thing is that if we were doing only synthetic assets with liquidity pools, to grow the TVL of the protocol, it could be a bit complicated. Basically, what we will need to do is to attract a lot of liquidity in USDC, and then to ask people to buy. And this is the problem. When you want to mint against a liquidity pool, you can only buy. You cannot sell, you cannot borrow. So you have USDC, you sell your USDC, and you have to buy JEuro. And what happens if you do not have USDC? If you have, for example, only UMA, you will need either to sell your UMA token or to borrow USDC using Aave, for example, or another protocol which could support UMA. And then you will sell your USDC to buy JEuro. So the problem is, I mean, to solve this problem, the idea was just to use a self-minting approach. And of course, Joke says we could use any stablecoin using the borrowing pool. For the liquidity pools, right now, we only want to use USDC. But that doesn't mean that in the future, we won't use other stablecoins. The thing is that to remain gas efficient, we didn't want to use multiple stablecoins at the same time, because if the liquidity provider is depositing USDC, but you want to trade with DAI, it means that behind the scene, we would need at some point to exchange DAI for USDC, for example, using Curve. But this will increase a lot the gas. And as of today, as you may know, it's not very a good idea. So the idea was to try to lower the gas as much as possible. And why we have used USDC and not DAI, the reason is quite easy to understand. USDC is a centralized tokenized dollar. So there are regulatory risks, censorship risks, which are associated with USDC. But USDC has also a very strong peg and a much better liquidity on both the fiat side and the crypto side than DAI. DAI, on the other hand, is more decentralized, a bit less now, since, as you may know, it is backed by a few centralized assets. But the problem is that DAI has technical risks, while USDC has regulatory risk. And regulatory risks are easier to anticipate and to mitigate rather than technical risk. You cannot anticipate a technical issue that will happen. And for us, for the beginning of our protocol, I didn't want to add any more technical risk. I mean, we are already built on the top of UMA protocol. We are using Chainlink. We have our own smart contracts as well. So, you know, the more layer we add and the more risk and systemic risk we add. So this is why, for now, I just wanted to use USDC. So that's it. So yeah, as I said, the borrowing pool allows to increase the TVL, to increase the liquidity in AMM. So for example, we could mint, the DAO has a lot of GRT. So the DAO could mint, for example, JEuro, JGBP, and they could create AMM pools with JEuro against JGBP. They could also, we can also, for example, our goal is to be on Aave. to be able to borrow and lend JEuro, JGBP, and so on. So from where could come this liquidity? Well, it will make more sense for you as a token holders or for the DAO to leverage from our holdings to mint JEuro, JGBP, and so on, and to deposit them on Aave. So this is why it's interesting to have a borrowing pool. Now, if there is no more question about this, I will explain you one of the first use case that I particularly like. So first, is there any question on the borrowing pool mechanism? Okay, so let's say no. So the question is, how could you be long or short on an AMM, automated market maker? So let me go through two examples. Let's say you are a forex trader and you would like to open a long position because you do think that the euro will appreciate against the dollar. So of course you can use a forex broker and so on, but here the point is to show you something pretty cool. It's called a risk-reduced long and short position. So how does it work? If you want to get long on an AMM, you first need USDC. Then you have to sell half of your USDC, 50%, to buy JEuro. The question is, how could you buy JEuro? So you have two choices. Either you use Synthereum directly, so you send 50%. So let's say that we start with 100 USDC. So you sell 50 USDC for JEuro on Synthereum. So you create a trading fees for the protocol, or you can use, of course, an AMM if for some reason the price is better, maybe because the price is lower than on Synthereum, for example. So in any case, you need to sell 50%, which means that you will end up having $50 worth of JEuro and $50 worth of USDC. And then you deposit both of them in the AMM pool. If you want to short, it's of course the exact opposite. You first need to start with JEuro, but you're gonna sell 50% for USDC, and then you deposit them on an AMM pool. In both cases, it is better, of course, for us, the DAO, the protocol, and the liquidity providers, to do this trade directly using the Synthereum liquidity providers. What if you do not have USDC to go long, but you can still borrow USDC? So for example, if you have Bitcoin or Ether and you want to go long on euro, you could borrow USDC on Aave using your Bitcoin holdings or ETH holdings, borrow USDC, sell half of them for JEuro, deposit them on the AMM. What happens if, of course, you want to be short, you will have now to borrow JEuro. And it's pretty cool because how could you borrow JEuro? I just said before, you can use a borrowing pool. So someone, for example, who would like to short JEuro, thinking that it will go down, they could borrow JEuro from our protocol, or they could borrow JEuro directly from Aave. I mean, if we succeed, of course, to list them there. And then they will sell half of the JEuro for USDC and deposit them in the pool. So how do we know that we are long and short? Easy. If the price of euro against USDC goes up, and if you are long, your position will increase in value. For example, remember we started with $100. If the price of the price of euro goes up by 10% against the price of dollar, then the value of your euro will go up by 10%. So $50 will worth now $55. And the USDC, of course, won't move. So it means that your position will go from $100 to $105. So you made profit. This is why this is a way to be long on an AMM. And vice versa, if the price of euro goes down by 10% against the dollar, sorry, no COVID, don't worry, then you will lose 5%. So this is a way where you can go long and short. So Nigel, actually, it's not complicated at all. The thing is that, of course, we don't want the user to have to go through all of this. If you, as a user, you want to go long, I won't ask you to go alone on Aave to borrow USDC, then to sell 50% against, of it against Euro, and then to deposit them. The idea will be to create fully automated vaults. So for example, you could say, hey, I have Bitcoin. I would like to short Euro on Jarvis. What can I do? You deposit your Bitcoin on the vault, and then everything could be automated. The vault will take the Bitcoin, borrow from Aave USDC, sell half of it on Synthereum Euro, deposit them on SushiSwap, and that's all. Nothing else to do. So yeah, that's pretty much it. Then for the one who are familiar with AMM, you may know that you have the risk of impermanent loss. So this, the problem is that either the price goes up or the price goes down. You always have the problem of the impermanent loss. So the question is, if the question was, if we want to provide risk-reduced long or short position on forex for anyone, how could we mitigate the impermanent loss, but also how could we mitigate the risk of losing if the trade goes on the other side of your position? So the cool thing is that forex is quite not very volatile. I mean, here you have, for example, for the last 3 years, in 2020, euro dollar went up by 6.25%, and in 2018 it went down by 4.66%. So it's basically what ETH or Bitcoin could do per day. So the cool thing is that when you provide liquidity for an AMM, you earn trading fees. Every time someone is buying or selling in this AMM, you as a liquidity provider, you are receiving the fees. So in the research paper that you can find on Twitter, on our website, you will see actually a big backtest of many pairs, so from euro dollar to JPY USD and so on, to show what is the daily volume required in order to that the fees completely offset the impermanent loss. So for example, here we see that in 2020, the impermanent loss could have been minus 0.46%. And to offset this risk, we will just have needed that every day 2.9% of, the volume, the daily volume should have been 2.9% of the global liquidity of the pool. And so this is pretty cool because it means that as soon as you just have this small amount of trades happening every day, the fees that you receive as a liquidity provider could totally offset the impermanent loss. But the most interesting part is not this, is what is happening if you are long and the price of your dollar goes down. So then here you will have two losses to offset. The first one is an impermanent loss. We have seen that on the forex market, on an AMM, it's not that complicated to offset this loss. You just need around 2% of daily volume relative to the total liquidity. But the cool thing with AMM liquidity provision is that most of the time the protocol is incentivizing you to provide liquidity. So on our side, we will distribute, the DAO, the protocol will distribute GRT and UMA token as a reward to liquidity provider. So I cannot tell you what will be the APY, but for sure at the beginning, it will be way above 15, let's say 9.49%, which means that when you provide liquidity for euro against USDC on an AMM, even if you are long and the price of your dollar goes down by maybe 5 or even 10% during the year, then the value of the incentives that you will receive will offset completely your losses and can also allow you to make profit. So if we pack this into a vault which constantly sell the incentives that they receive to buy a J-Euro or USDC or this kind of thing, we could create vaults which says, okay, you can deposit your money there. You can decide if you want to go long or if you want to go short on, for now it's forex, but when we will add stocks or commodities or this kind of asset, it will also be the case for those assets. And basically we say, whatever happens, you will still make money as soon as the rewards that we are capable of giving are above the negative performance of the market. So this is pretty cool value proposition, because we can basically create a small UI, and instead of asking people to go through Synthereum and do many different manipulation, we just tell them, okay, put your funds there, click on long shorts, and that's it. So this is one of the use case. And for people who are farmer, basically, you can farm GRT and UMA by providing liquidity on a Euro, USDC, or GBP USDC pool on an AMM. And for the ones who are not farmers and they just want to trade, it will work the same way, but from their perspective, they are not aware about farming and this kind of thing. They will just see that whatever happens, it will be profitable for them. And at the end of the day, they will still make money when they close their position. So this was for the risk-reduced long and short FX trading. Another way to make profit using Synthereum, apart from being a liquidity provider on an AMM, it's to be a liquidity provider on Synthereum. So remember, there are two ways to mint synthetic assets. Either you mint synthetic asset against a liquidity pool, which means that we need liquidity, or you mint a synthetic asset alone. So basically you borrow from the protocol. In the first case, we need a lot of liquidity, because unlike synthetics, as I said at the beginning, we do not issue debt. So we cannot print money. We cannot say, hey, this person has won $1,000, let's print 1,000 USD. No, here the problem is that we need USDC in order to pay everyone. So it means that the Synthereum protocol has to attract a lot of liquidity, at least for USDC. So when you want to provide liquidity on Synthereum, you are basically always short. So if you want to provide liquidity for the Euro pool, you basically hold a short Euro position. The problem is that if you think that Euro will go up, and if you are right, it means that you will basically lose money. So the cool thing is that you can hedge. So hedging is you have to buy an asset, you have to hold an asset which will outperform the performance of, for example, the Euro. If the asset that you are holding is basically beating the performance of Euro, then you are hedged and you won't lose money. Of course, the problem is that if the hedge is not perfect, and if the market, what you expect basically do not happen. So for example, Euro goes up and unfortunately your asset is going down, then you lose money. Nevertheless, the way to be not market neutral, but to hedge your risk, being a liquidity provider on Synthereum, will be actually to borrow USDC. So if you do not have USDC, or instead of buying USDC, you can use, for example, collateral in BTC, or even better, you can use, if you don't want to take too much risk, a collateral in J-Euro. So this is where the things comes interesting. Imagine that the DAO, with all their GRT and UMA token, will mint a lot of J-Euro. And then the DAO put those J-Euro on AAV. So then anyone could go on AAV, deposit as well J-Euro, borrow with those J-Euro some USDC, and then use those USDC to provide liquidity on Synthereum. So what is happening here is that you have J-Euro, so you bought them, so you hold J-Euro. So if the price goes up, your J-Euro goes up as well. Then you borrow USDC, which means that you are somehow short with USDC. You deposit those USDC in the liquidity pool. against, I mean, to provide liquidity for euro. And every time someone will buy J euro from your liquidity pool, you will be short in J euro. But at the same time, remember that you are long J euro because you have borrowed USDC using J euro. So it's pretty cool because with, sorry, because it means that you can be almost market neutral while you provide liquidity for Synthereum. And when you provide liquidity for Synthereum, you earn trading fees, but also, again, you will earn incentives, UMA and GRT incentives. So a liquidity provider for Synthereum could have USDC or borrow USDC, but honestly, borrowing USDC will be more interesting. So you borrow USDC, you can even borrow USDC directly, as I said, I mean, from from AV and so on, as soon as we are listed there with J euro as collateral. And you are almost market neutral. You earn the trading fees and you earn the incentives in GRT and in UMA. So in both cases, when you provide liquidity on an AMM or if you provide liquidity on Synthereum, you can be hedged and just earn incentives and of course the trading fees. Now I will explain you last use cases, which is basically my favorite, and I think it's the one which will generate the most of the cash flow actually. So you have again to remember the way a liquidity pool is working. So in this screenshot, you can see on the left how much it cost in USDC. It was a few days ago to buy one Bitcoin. I mean, a wrapped Bitcoin. And on the right, how much it costs in euro to buy the same wrapped Bitcoin at the same time. As you can see, the slippage, so the price impact for USDC is 0.07%. The price impact for Euro S, which is a tokenized euro by Stasis, the price impact will be 0.83%. Well, it's normal. Uniswap is using a routine. You go from Euro S for USDC, for ETH, and then for wrapped BTC. So there are more transactions and more slippage. But the problem is not this. The problem is that Euro Stasis on Uniswap, they have $14 million of liquidity. So with $14 million of liquidity, unfortunately, someone who will want to buy Bitcoin with Euro S will have to be impacted with a price impact of the slippage of 0.83%. So you're going to tell me, yeah, but they could buy directly using Curve, for example, with their synthetics bridge. They could swap Euro S for S Euro for SUSD, and SUSD for SBTC. It's true, but first, the gas is quite expensive to do this swap for now, and it may work for wrapped BTC, but it doesn't work for other assets. So you need, for example, synthetics to provide synthetic asset for basically all the other assets. Regardless, with euro, it's an example, but now try to imagine for another currency. For Canadian dollar, for example, on Uniswap, the liquidity is almost inexistent. Or for another currency, for example, the Naira, the currency in Nigeria, which basically doesn't exist in Uniswap. So the problem is that as soon as you do not use USDC to do a trade on an AMM, then you have a huge slippage. So this is what we want to solve with the Onchain liquidity router, which basically is an atomic swap between Synthereum and an AMM. So the way it works, it's quite easy. Let's imagine that you have JCHF, so the Swiss franc by Synthereum, and you want to buy wrapped BTC. So the best way is not to create an AMM pair using JCHF against ETH, for example. This will be capital inefficient. Of course, we will incentivize such pool, but you have seen why. It's because we want to allow people to go long and short with a very reduced risk using an AMM. Here, the best way is actually to exchange, so to swap the Swiss franc for USDC using directly Synthereum, so at the Oracle price. So no slippage is happening here. Then the USDC is sent through an AMM or an aggregator or any protocol to swap them for WBTC. So it means that we have the same slippage as USDC, yet we have both Bitcoin with Swiss franc. So for example, when we will launch this on the mainnet, you will be able on Jarvis Exchange to buy with euro. You will be able to buy 1 Bitcoin using euro, but at the same slippage, and so therefore the same price as you could have done with USDC. So basically, we could provide a better pricing than what Stasis can provide with their system, where they just deposit liquidity in an AMM. So imagine here the consequences, because we spoke about wrapped BTC, but now imagine other tokens. So we could, for example, buy AAV token with JGBP, and the liquidity for AAV against pound is quite low, while the liquidity for USDC against AAV is quite important. So by doing that, we could actually give to any token on an AMM the very same liquidity as USDC. And this is pretty cool because, again, this could generate a lot of transaction fees, because we can go in any country and say, okay, you do not need anymore, if you are a market maker, to do market making for one currency against Bitcoin or one currency against ETH. You can maximize your money by keeping doing market making for USD Bitcoin or USD ETH and so on. And to interact with Synthereum, I mean, the user will interact with Synthereum to only buy any currency using USDC basically as a liquidity bridge. So imagine also now, I told you before about Curve, and I think you know about the Curve and Synthetics somehow partnership and synergy. So imagine now if this AMM is not Uniswap or SwitchSwap, but Curve. So we can make GCHF exchange for USDC at the Oracle price. And then, for example, to go on Curve, exchange was USDC for SUSD, SUSD for SBTC, SBTC for wrapped BTC. So we can even, by leveraging from the Curve and Synthetics synergy, create even a better price for all our synthetic assets to buy wrapped BTC, ETH, or Link token, because now Link is on Curve as well. We can also, of course, use aggregator like Paraswap or 1inch, and some protocols, for example. But this we can develop this idea another time, where basically you have JCHF and you want to interact with a protocol that only supports USDC. So we can wrap a few transactions at once, where you burn GCHF or USDC, deposit the USDC, but at the same time we open a leverage position. So using a derivative pool, this is why derivative pool will be cool, to open a long position on JCHF. So this will allow you to maintain an exposure to the Swiss franc while using USDC in another protocol. But one of the coolest use cases is if we combine the on-chain liquidity router, so this atomic transaction, with an on or off ramp. So imagine if you are in Switzerland and you have Swiss franc and you want to buy wrapped BTC. So what you can do is deposit your Swiss franc on an exchange which supports this currency, for example, Liquidity, or you can use a service such as Swissborg, and then you will buy Bitcoin using your Swiss franc. The problem is that in terms of liquidity, as you may know, the Swiss franc is way below USDC when it comes to buy Bitcoin. So it means that you will have less interesting pricing if you buy your Bitcoin with Swiss franc. So the idea is that if you use Synthereum as well as an AMM or an aggregator, we could exchange the Swiss franc for J Swiss franc. Then those J Swiss franc could be exchanged at the Oracle price for USDC, and then the USDC will be exchanged, of course, for wrapped BTC. So doing that, the liquidity between the initial Swiss franc and the output, I mean the last output, so the wrapped BTC, will equal the liquidity and the slippage of USDC against wrapped BTC. The only thing, of course, here that you have to pay will be the trading fees of Synthereum as well as of course, the gas. This is why this kind of thing will be way better and way more interesting on scaling layer. But I think you get the point. And the cool thing with that is that first, we could onboard more people in DeFi. For example, if we are in Nigeria and we launch the J-Naira and we create an on-ramp where people are able to exchange their Naira for J-Naira. So first, they could, if they want, sell their J-Naira for USDC, and then they can enjoy DeFi. So it can be used as an onboarding tool, a fiat gateway, basically, for DeFi in various countries. But it also reduces market inefficiencies. For example, when you are in Nigeria, if you want to buy Bitcoin, you may have read some articles about it, or maybe you are in Nigeria or you know someone there. The price of the Bitcoin there is way higher than the price on exchange in Europe or USA. And the reason is that first, it's a market which is closed. I mean, it's quite hard to do arbitrage or to buy dollar at the real market price. And also, the market makers there, they have low liquidity and they only provide trading against the Naira. They do not provide trading against the dollar. And if you want to buy dollar, you need to go through different routes. And again, it's not the most optimal prices that you will do. So imagine now if we tell Nigerian people that using Synthereum and an on-ramp, they could buy Bitcoin at the same price that we do in Europe or in America or in Asia. So we just tell them, buy J-Naira with your Naira, and then just do an atomic swap on our DEX. You exchange your J-Naira for USDC and USDC for wrapped Bitcoin. And boom, suddenly you just bought wrapped BTC, so BTC, at a way lower price than what you can buy on a local exchange. So this will be a tool for market maker and arbitrager to actually reduce the market inefficiency. They could then sell, they bought Bitcoin at low price, they could sell it at a higher price on an exchange. Of course, it's wrapped BTC, so they will need to use REN protocol and WTC cafe to exchange those wrapped BTC for real BTC. But as soon as it is done, they can go on a local exchange, sell the Bitcoin at a higher price, make a profit, helps the price of the Bitcoin to goes down in those countries, and and do this again and over again. So it's me, I like it because DeFi usually it's all about farming and how we can make money quite fast and so on. While here we can have a real impact and you can really deliver something that has a lot of value for many people. And if it has a lot of value, they will use it. And if they use it, it will generate fees and so on and so on and so on. So this is for the use case using the on-chain liquidity router. Let's finish with two things. So the DAO. So the DAO will receive 50% of all the trading fees, but also the borrowing fees, because when we will launch the borrowing pools, there will be two kinds of fees. There will be some interests on collateral, and there will be some fees when you open, basically, when you borrow and when you repay, there will be a fee, and those fees and interest will go directly to the DAO. And we are part of the UMA protocol. So like all the other projects, we are receiving every week UMA rewards. So this is pretty cool because imagine the use case where the DAO receives UMA token, use the UMA token to mint JEuro, deposit the JEuro, for example, in an AMM or in AAV, and just lend the JEuro there, make profit. And because we mint JEuro with UMA token, the value of the synthetic asset minted by the protocol increases, and so we receive more UMA rewards, and so on and so on and so on. So we can create some kind of nice loop where the DAO grows in value and grows its treasury. And the point of having the UMA token is not necessarily to sell them directly and to make profit. No, it's to use the UMA for voting in the UMA governance. But also, as you can see here, this is the address that we're using for for the yet to come DAO, we farm actually sushi using the UMA token that we receive. So right now we have received almost $7,000 of UMA token, and we are farming sushi token with them. And the point is to grow the treasury of the DAO to multi-million, multi-billion. And us GRT holders, we just have to decide what to do with this treasury and how to better utilize it in order to grow the protocol even more. The GRT, so as I said, it governs the DAO, so both the protocol and the treasury. Protocols are parameters. So for example, if we want to modify the collateral ratio, if we want to modify the threshold when a liquidation happens, if we want to modify the fees and so on and so on, or if we want to add a collateral. Let's say we want to add GRT, we need to vote about it. Then the GRT will be used as collateral. So I won't speak about the new token economic here, but what I can tell you is that there will be a token called the DAO GRT. So I will let you imagine what it is. And I think the best way to give value to the token is not necessarily to accept GRT as collateral, but DAO GRT as collateral. Staking for liquidity provider as well. This will be introduced at some point. Again, I won't give too much detail here. We are preparing an article about our upcoming token economics. And of course, it is used for incentives, hence the word reward and Jarvis reward token. The idea is, of course, to reward the network participation and activity. For the roadmap, so as I said, soon there will be new token economics because honestly, we have, I think, an incredible project. I mean, I'm very excited by what we are doing now. I know what is upside, the niche in which we are, and I mean, DeFi is so exciting. But it's true that our token has not a lot of utility. As of today, it is used for governance. It was supposed to be used also for staking, for relayers and validators, and that's all. So the problem with this model is that it gives a floor, not a floor, but a ceiling to the token. Because if your token helps to govern something, and if your token is used for staking to earn something, it means that you can price the token. You can say, okay, according to the money that I can make with GRT, according to the value the GRT allows to capture, then the price of the GRT should be this. And you just use a classical valorization pricing model. But if you add some utility that cannot be priced, then you do not have any ceiling to the market cap or the value that the token can have. So the idea was this is how we could still have a token which captures the value, yet to do not block the valuation of the token to the network value. And one of the ways is to use it as collateral, among other things that we'll introduce at some point. Then we're going to launch the double farming using GRT and UMA for liquidity provider on AMM. And then when we will allow more people to become liquidity provider on Synthereum, there will be the double farming for liquidity provider on Synthereum. At some point also, we want to add a USDC collateral in for Synthereum. So here, the idea is simple. Right now, the liquidity pools are with USDC. And the problem is that those USDC, they are sleeping. They do not make money. So the idea is to deposit those USDC in AAV so the collateral can finally earn interest. And the idea is that those interests, 100% of those interests, should be redistributed to the liquidity provider. This way, liquidity provider on Synthereum, they can earn trading fees, incentives in GRT and UMA token, and also they could earn interest from the USDC deposited as collateral. Audits. So we actually have finished our first audit. It was finished this week. We will address first a few of the points in this audit, and then we're going to make an official announcement. But so far, so good. There was no critical issues that have been found. And it's very good for us because it's our first audit, so it's a first good milestone. And there will be 2 or 3 more audits that will happen. It doesn't mean they will happen now. There will be another audit soon. And then every time we're going to add a new feature, we will need to make a new audit and this kind of thing. And also, we would like to work with white hackers and bounty hunter, I mean, not bounty hunter, but bug bounty, to have some kind of ongoing security audit. Then, of course, we have to launch the Onchain liquidity router. So this will allow to make atomic swap between non-synthetic asset and synthetic asset. We have to launch the DAO, of course, fiat on-ramp integration, money market integration, so to go on AAV, compound, and so on. More DeFi integration, we need to go in curve for sure, unslashed, because we need to have a proper insurance for our liquidity providers and our user in case there is a hack or an exploit at some point. It will be good to have some kind of insurance and security here. We will also introduce a multiple liquidity provider, which means that anyone will be able to become liquidity provider in Synthereum. And of course, scaling layer. So this is something that we didn't think about doing it. I mean, now, I mean, the point was, okay, we're gonna work on the scalability a bit later. The point now is try to grow the network and to secure it and so on. But I also don't want to have a protocol which is hardly usable because of the gas fee. And right now, again, it's like between $50 and $300 to mint a synthetic asset. So it's not very scalable. So the thing here is that because we are built on UMA and Chainlink, it's not that easy for us to move to the EVM compatible chain of our choice. Of course, we would like to go on Polygon, we would like to go on Optimism, we would even like to go on BSC and other EVM compatible chain. I think AVAX as well is compatible, and many other projects are working on EVM compatible solution. But Chainlink is quite fast to go to the solution, but we also need UMA to create bridges between Ethereum and those chain, because the liquidation and the dispute system happens on Ethereum layer 1 in the UMA protocol. So we need to create a bridge between UMA on the layer 1 and those scaling solution. So UMA are working on several things like that. And we are waiting for them to be ready for that before we can move to this kind of solution. So that's pretty much it for the presentation. So the point was to try to review a bit the research paper that we have published. I encourage you to read this paper. It's actually quite, how to say, quite fast to read, even though it's 40 pages. There are a lot of illustrations, there are tables, and it's written with a line spacing quite big. And it will give you, more in-depth data and things like that to better understand what we do. A broader communication campaign. Yes, I mean, we have the money for that. The question is when, because, there is this marketing strategy that many are using. It's called fake it until you make it. And it works very good. I mean, most of the blockchain and project, they are doing it. So they make big marketing campaigns saying many things, and they over present themselves, let's say. It's not in our, let's say, way of doing. Usually we are more quiet and we want to build and then to focus on the marketing. But it's very important anyway to have a good big marketing campaign. So as soon as we have way more liquidity, and we have the borrowing system in place and the farming and so on, yes, we will start a marketing campaign. The thing is that if we start a marketing campaign now and people like it and come to our application and they realize that actually there is not enough liquidity for their trades, they will think, okay, but I will not come back. The first impression is always very important. So it's a double sword, because if we don't do marketing, no one will hear about us, and the token won't appreciate. And this is what most of the token holders are expecting, and the community as well. If we do marketing, we're gonna too much marketing, we will disappoint people, and finally it will be the same. So we have to find the good balance, and to start to do marketing when the time will be, in timely manner. But on my side, I have a community in France, and I have a network in France. And what we do here is basically trading. You know, when I was telling you that we can do forex trading with a very reduced, if no risk, I mean market risk, huh? There is still the hack risk and so on. It's for a reason. It's because I know that this kind of thing could be liked by forex trader, indexes trader. You know, if tomorrow we launch, for example, DAX, which is a German indexes, I know many swing trader in DAX, trading the DAX. I explain them. It's people who trade with low leverage. You know, they trade with leverage of 2, 3, maximum 5. So I explain them that with Synthereum, they could do a leverage of 1 or 2 for now, maximum, for example, and they could do swing trading on DAX for a few days or a few weeks. If we are on a layer 2, of course, to avoid the fees to eat all the performance. And they could be almost sure to do not lose money. So basically, one of the biggest thing we can do is to pack this into another trading platform, so totally different from Jerry's exchange, where you go and you said, okay, I want to buy DAX, I want to buy euro, I want to buy gold, but I want my risk to be almost inexistent. So what will happen behind the scene is what I explained before, and this is why I explained you the AMM system. We will basically take their money, put it in an AMM, earn fees, earn incentives, and if there is a loss, the incentives could be sold to reimburse this loss and even make a profit. And yeah, this is quite actually a pretty cool product. And then with the on-chain liquidity routing, you barely do not need marketing. So for example, we did a test in Cameroon 1 or 2 weeks ago. So what happened is that in Cameroon, you have a lot of demand for Ether and for Bitcoin, but you have the same issue as in Nigeria, in other countries. The prices there are way more expensive than what we can buy on Uniswap, for example. So we have one of our investors who is someone from Cameroon. He's a committee member, sorry, and he basically has how to say, he has a company which can acquire payments. He can accept payments, and so he can do a fiat gateway for crypto. So most of the time he contacted me and said, Pascal, there is a big demand in Cameroon that I cannot satisfy. Do you know liquidity provider? Do you know market maker with who I can work to basically content those people who wants to buy Bitcoin? And every time I introduce him to market makers, those market makers were not interested, because first it's for small amounts, you know, we don't speak about huge amount. And it's also for like risky market. But with this solution, what happens last week, so this user, he has J-Euro. So he has a reserve of J-Euro. And what you have to know is that in Cameroon, they use CFA, franc CFA, which is a currency pegged to the price of euro. So basically, holding euro equals holding CFA. So he has this J-Euro holding, and he's just waiting for someone to come to his office and say, I want to buy ETH, but wait, I don't want to buy ETH at the market price in Cameroon. I want to buy ETH at the market price worldwide. So what's happened here is that he receives a payment. So for example, he received $1,000 in CFA, in cash. He do his KYC, he does his AML. I mean, this is his risk management. And then what he's doing, he takes $1,000 of J-Euro, and there is no atomic swap yet. So for now, he has done 2 transactions. So what he has done, he has burnt $1,000 of J-Euro to release 1,000 USDC. And then he has used those 1,000 USDC to buy ETH on Uniswap. And then he has sent those ETH to the buyer. And the buyer have bought ETH at a way lower price than what can be bought usually in Cameroon. Of course, the transaction was not profitable for our friend because of the gas fee on Ethereum, but it was just for the principal. So this kind of thing doesn't require marketing. I mean, as soon as you know, in those countries like in Nigeria, just today again, I interviewed a Solidity developer from Nigeria. When I explained him what we can do with Genera, he wanted to stop the interview and say, I want to work here. I mean, I want to do this for the people in Nigeria because I know there is a demand, I know there is a market, and yeah, this is a very cool use case. So yeah, no need for marketing for this kind of thing. And for the rest, yeah, there will be the farming, and For me, the biggest form of marketing is education. If you provide content on YouTube, for example, with high value content, high educational value content, you will have the sympathy of people, and they will like because they learn things. They can even make money with what you tell them. And so my point is, at least in France, to be, let's say, one of the reference in DeFi. And to do so, I'm participating to many conferences. I'm invited to many interviews and this kind of thing. I know it's not very visible for people who are not French, but you know, I have to start with French because there is a big market there. It doesn't matter what we think. And I will also publish a lot of videos about DeFi to try to understand how it works, how an AMM works, and this kind of thing. So yeah, basically this will be our marketing. Okay, so if you have question, feel free. So Tom, I've got some USDC and GRT. Give me the TLDR, how to farm max UMA with GRT. The best time will be when we launch our farming DApp. You will need to mint so J Euro, and you provide liquidity in Uniswap, SushiSwap, J Euro against USDC, and you will receive both GRT and UMA token, so double farming. And it will be even cooler if we could participate to an Onchain program. Can you imagine we could have sushi reward, UMA reward, GRT reward? So this could attract even more liquidity. And the more liquidity you receive, the more UMA token we receive, and so on and so on and so on. We work on the article, Jean, so. Yeah, the beard has grown a bit. Okay, so yeah, Tom, mint J Euro, have USDC, provide liquidity, and farm. Synthetics is of course the biggest competitor, and that's all actually. It's the only competitor I can really think about. Of course, there are many other competitors for synthetic asset, but again, our niche is forex, and in forex, the only one that really can compete is synthetics. All the other protocols, they are focused on stocks and so on. So yeah, I think it's because many protocols they think, okay, how we can attract users? Let's make something sexy. Let's provide stocks, indexes, crypto, and this kind of thing for synthetic assets. While forex is not sexy at all. I mean, honestly, who will buy euro while you know that it can just go up by 5 or 6% per year? No one. But it's because they misunderstand the value and that can be captured by forex and the importance of forex in DeFi. And me, I see this value, I see this niche, and I want to dive into it because at the end of the day, we have to become the forex layer of DeFi. The new token economics, Cannibal, it's quite easy. So first, we didn't give that much detail. There will be an article about it. But basically, The biggest thing that you have to remember is that it will be used as collateral. This was something that since day one, all our investors, they have asked like, hey, it will be good to have GRT as collateral so we can unlock the liquidity. But we're like, yeah, maybe one day, but when the time will come. And now with our design in Synthereum, we could do it actually quite soon. So yeah, GRT as collateral and also staking for liquidity provider. This will come at some point as well. But commodities will follow the same methodology of fiat token. Yeah, this the DAO will decide, because if we launch commodities with USDC liquidity pool, we will need the market maker who will be okay to provide liquidity for that. So we'll see. Maybe it will be just borrowing. Maybe it will be both borrowing and liquidity pool. We'll see. There's also many cool things that we can do with this design. I said at the beginning, we can do derivative pool and so on. So this will be also pretty cool. Yeah, optimism is pretty popular. The problem with optimism is it's the 1 week, to go out. But it will be solved by a liquidity provider, and I'm pretty sure that you have seen what Maker have proposed. So anyway, we will go where the network is. I mean, I'm not an Ethereum maximalist. I am a network maximalist. So if everyone is on optimism, we will go on optimism and we will stay on optimism. If everyone is on Polygon, we will go on Polygon and we will stay on Polygon. So the idea is actually to do not choose and to go everywhere. So to go on optimism, to go on Polygon, to go on BSC, XDAI, and so on and so on, and to just let the traction go. So if all the traction is on optimism, there is no point for us to stay on Polygon, for example. Okay, guys, so at the end of this live, it was a long day. I think you see it with my eyes. So tomorrow at the same time, there will be one for the French community. And next month, we're gonna do one. So next month we will, as I said, explain a bit. It will be shorter, of course, because I won't have I won't need to explain you all the protocol. It will just be an update, and that's pretty much it. In the meantime, for the one who goes on app.jaris.exchange and they want to mint synthetic assets, the fees are very high, but we won't incentivize you for now to mint. I mean, actually, we have discussed with the community on Discord that we don't want for now to incentivize. But you may receive a very cool NFT if you farm before we launch the farming. So we never know. Maybe NFT one day could worth some money. So that's all. I haven't checked Arbitrum. Honestly, I haven't checked many things. I mean, I try to focus on 2-3 things. So for now, it's Polygon, BSC, and Optimism. BSC because of the user base. I mean, let's be honest. We are here for what? We are here to have users. And the way to have users is to go where users are. So one of my biggest goal is to actually deploy the system on BSC, not to make just a wrapper. I really want to deploy the pool on BSC. USDC is already on BSC, so we can reuse USDC. We can even use BUSD as well. But yeah, to go there, it will be crucial, I think, for us. Right now, to farm before the launch of the farming, no, there is just the farming on Sushi. You can deposit GRT ETH and earn Sushi token, and you can, of course, deposit GRT ETH in Uniswap and earn GRT. Okay, guys, thanks for your attention, and see you soon.